Something is quietly unfolding inside one of the world's most stable economies. It has the potential to ripple across the globe. It could make mortgages more expensive, it could pressure stock markets, and it could reshape the future of money itself. And here's the unsettling part. Most people won't see it coming. But this isn't a sudden crash. It's not dramatic headlines. It's not the kind of event that dominates the news cycle. It's a slow shift in the foundation of the global financial system. And at the center of it all is Japan. For decades, Japan has played a silent but critical role in keeping the global economy stable. Not through politics, not through headlines, but through money, cheap money. But today, that system is starting to change. And when a system that has supported global markets for more than 30 years begins to shift, the consequences don't stay local. They spread across countries, across markets, and eventually into your everyday financial life. Japan is one of the largest holders of US government debt, holding over $1 trillion in US treasuries. This means, in simple terms, the United States has relied on Japan as one of its biggest lenders. Now think about that for a moment. If one of your biggest lenders suddenly changes strategy, that affects everything. And that's exactly what's beginning to happen. Recently, Japan's long-term bond yields have started rising to levels not seen in decades. And while that might sound like a small technical detail, in finance, interest rates are never just technical. They are foundational. They determine how expensive it is to borrow money. They influence how assets are valued, and they shape the direction of entire economies. So when interest rates begin to rise in a country like Japan, it sends signals across the entire financial system. Now, to understand why this matters so much, we need to go back to the late 1980s. Japan was experiencing one of the largest financial bubbles in modern history. Stock prices surged, real estate prices skyrocketed. At one point, the land beneath Tokyo's Imperial Palace was valued higher than all the real estate in California combined. That's how extreme things began. But as with all bubbles, it didn't last. When it burst, the consequences were severe. Markets collapsed, wealth disappeared, and Japan entered a long period of economic stagnation. But what followed was even more unusual. Instead of high inflation, Japan experienced deflation. Prices began to fall. And while that might sound like a good thing on the surface, it created a dangerous cycle. Because when people expect prices to fall, they delay spending. If something will be cheaper tomorrow, why buy it today? But when millions of people make that same decision, the economy slows down. Businesses sell less, profits decline, and jobs are cut. And that leads to even less spending. This is known as deflationary spiral, and Japan was stuck in it for years. To break out of this cycle, the government and central bank took extreme measures. Interest rates were pushed down to near zero, eventually even below zero. At the same time, the Bank of Japan began buying government bonds on a massive scale. The policy became known as quantitative easing. But Japan went even further. They introduced something called yield curve control. Instead of simply influencing interest rates, they actively controlled how high those interest rates could go. Over time, this led to a remarkable situation. The central bank came to own a significant portion of the government bond market, in some cases, dominating it entirely. This allowed Japan to keep borrowing costs artificially low, which meant they could sustain very high levels of debt without immediate consequences. And this brings us to the core of the issue. Japan's debt-to-GDP ratio is over 200%. To put that into perspective, imagine earning £100,000 per year, but owing more than $220,000. That's the scale of the imbalance. Normally, this would be unsustainable. But because interest rates were so low, the system held together for decades. But now something is changing. Inflation is returning, prices are rising, not dramatically, but enough to shift the environment. And that creates a new problem. Because central banks cannot ignore inflation, they are expected to respond, typically by raising interest rates. But for Japan, rising rates come with serious consequences. Higher rates mean higher costs to service their massive debt. At the same time, keeping rates low risks weakening the currency and allowing inflation to accelerate. So Japan is now facing a difficult choice: raise rates and strain the system, or keep rates low and risk losing control of inflation. There is no easy path forward, and this is where the global impact begins. For years, Japan has been a key driver of global liquidity through something known as the carry trade. This strategy was simple: borrow money in Japan at very low interest rates, convert that money into dollars, and invest it in high-yielding assets like US bonds or stocks. As long as borrowing costs stayed low, this strategy generated consistent profits, and it became widely used by institutional investors. But now that equation is changing. As interest rates rise in Japan, borrowing is no longer as cheap, which means the profit margin from the carry trade begins to shrink. And when that margin disappears, the incentive disappears too. So, what do investors do? They unwind their positions. They sell foreign assets, convert their money back into yen, and reduce their exposure. This process is known as an unwind. And when it happens at scale, it creates pressure, because large amounts of capital begin moving in the opposite direction, out of global markets and back into Japan. Now remember, Japan is one of the largest foreign holders of US government debt. So if Japanese investors begin selling those assets, it has consequences. It pushes US bond yields higher. And when bond yields rise, everything else adjusts. Mortgage rates increase. Borrowing becomes more expensive. Businesses take on less debt, and investment slows down. At the same time, higher interest rates affect how stocks are valued. Many companies are valued based on future earnings, but those future earnings are discounted based on interest rates. When rates rise, those future earnings become less valuable in today's terms, which means stock prices can fall, even if the companies themselves are performing well. And this is how a shift in Japan can begin to affect your financial life, through higher mortgage costs, through changes in investment returns, through a more expensive cost of money overall. But the situation doesn't end there, because Japan is not alone. The United States, the United Kingdom, and much of Europe are all carrying significant levels of debt, which means they all rely on low interest rates and continuous demand for their bonds. But now, something is changing globally. These economies are beginning to compete for the same pool of capital, and there is only so much capital available. So, what happens next? There are three possible paths. The first is a gradual adjustment, where Japan slowly raises interest rates, markets adapt, and the system stabilizes over time. The second is a faster unwind, where investors rapidly shift capital, causing volatility across global markets. And the third is a more severe outcome, where rising debt costs become difficult to manage, leading to broader financial stress. The most likely outcome is a slow transition, but even a slow transition can have significant long-term effects because it changes the rules. For decades, the global economy has been supported by cheap money, easy borrowing, and abundant liquidity. But that environment is beginning to shift. And in a world where money is no longer cheap, decisions carry more weight. Risk becomes visible, and awareness becomes more valuable. This is not about predicting a crisis. It's about recognizing a shift. Because the most important changes in the financial world rarely happen all at once. They happen gradually, quietly, until one day the impact becomes impossible to ignore. And for those who are paying attention, those changes create insight. And insight creates an advantage, because understanding how money moves changes how you move. And over time, that difference compounds. The global financial system is evolving, and Japan is at the center of one of its most important transitions. What happens next will not just shape markets, it will shape the environment in which wealth is built. And in times like these, clarity is not just useful, it's essential, because the people who understand the system are the ones best positioned within it. And that is what separates awareness from reaction.